Hello everyone, Namaste. Welcome to my channel Study with Amit Singh. In our previous video, we have learned electronic fund transfer, correspondent banking, RDC, PTA, and discussed case study on every topic. We have also discussed how we can switch to a KYC AML profile, what important point we need to keep in our mind while in transition period. We have discussed the day-to-day activity of transition monitoring analyst, KYC analyst, and we have discussed the basics of KYC AML, basics of FATF, Palermo Convention, and we have discussed some of the case study on these topics. In today's video, we will discuss how money launderers use bank and other depository institution to launder the money, like concentration account, private banking, use of PICs and private banking, politically exposed person, structuring, microstructuring, and we'll discuss some of the case study on every method so that you can understand these terms very easily. But before that, if you did not subscribe the channel yet, then please subscribe it and ring the notification bell so you don't miss any update and upcoming videos. Let's start with the concentration account. The concentration account are internal account established to facilitate the processing and settlement of multiple or individual customer transactions within the bank, usually on the same day. They do this by aggregating funds from several locations into one centralized account. Concentration accounts are also known as special use, omnibus, settlement, suspense, intraday, sweep, and collection accounts. They are frequently used to facilitate transactions for private banking, trust, and custody accounts, fund transfers, and international affiliates. Money laundering risk can arise in concentration accounts when the customer identifying information such as name, transaction amount, account number is separated from the financial transactions. When the separation occurs, the audit trail is lost and account can be misused or administered improperly. Bank that is used concentration accounts should implement adequate policies, procedures, and processing covering operations and record keeping for these accounts, including with requiring dual signature on general ledger tickets, prohibiting direct customer access to concentration accounts, capturing customer transaction in the customer's account statement, prohibiting customers' knowledge on the concentration account and their ability to direct employee to conduct transactions to these account, retaining appropriate transactions and customer identification information, frequently reconciling accounts by an individual who is independent of the transactions, establishing a timely discrepancy solution process, identifying and monitoring recurring customer names. So this is all about concentration accounts. Let's discuss about the private banking. Private banking is an extremely lucrative and competitive global industry. Since 2008 financial crisis, global regulators have placed greater scrutiny on private bank and their services. Private banking provide highly personalized and confidential product and services to wealthy clients at fees that are often based on asset under management. Private banking often operates semi-autonomously from other part of the bank. Fierce competition among private bankers for the high net worth individual who are their main clientele has given a rise to the need of tighter government controls worldwide. Competition brings increased pressure on the relationship manager and the marketing officer to obtain new clients, increase of their asset under management, and contribute a greater percentage to the net income of their organizations. In addition, the compensation paid to the most relationship manager in private banking is based largely on asset under management that they bring to their organizations. Let's discuss the risk of private banking. The following factor that can contribute to the vulnerabilities of private banking to the money laundering: perceived high profitability, intense competition, powerful clientele, high level of confidentiality, close trust developed between relationship manager and the client, commission-based compensation for relationship manager, culture of secrecy and discretion developed by the relationship manager for their client, role of relationship managers as a client advocate to the protect their client, use of private investment companies by client to reduce transparency of their beneficial owners, uh, client maintaining personal and businesses wealth in numerous jurisdictions including offshore jurisdictions, client ability to utilize and control numerous legal entities for the personal data and family estate planning purposes. Let's understand this with the case study for the private banking. In 2015, the British regulator, the Financial Conduct Authority (FCA), fined Barclays Global Bank for AML safety violation. These regulatory bills related to 1.88 billion euros transaction that Barclays arranged and executed in 2011 and 12 for several ultra high net worth customers. The customer involved were politically exposed person (PEP) and should therefore have been subjected to enhanced level of due diligence and monitoring by the Barclays. However, Barclays did not follow its standard procedure and policies. In fact, it applied a lower level of due diligence than was required for the customer with the lower risk profile. The FCA fined Barclays more than 72 million euros, which included the amount of revenue that Barclays generated from the transaction of 52 million euros and penalties. On the date of fine, it was highest AML related fine the FCA had ever issued. Although the FCA concluded that the transactions was not linked to the financial crime activity, it assessed the transaction as a high risk due to the involvement of private banking, ultra high net worth customer and PEPs. Among the other factor, high risk transaction and customer require EDD measures which the Barclays failed to conduct. Barclays policies and procedures required EDD. However, staff linked to the transaction did not follow them, and senior management failed to oversee the handling of the associated financial crime risk. Investigator claimed Barclays sought profit over compliance, onboarding the client as quickly as possible to generate 52.3 million in euros in revenue. Let's understand this. Yeah, so Barclays did not obtain the necessary information from the customer to comply with the financial crime requirement. The staff failed to establish the purpose and nature of the transaction and did not sufficiently corroborate the source of wealth and fund for the customers and the transactions. Barclays agreed to keep details of the transaction strictly confidential even within the firm and to compensate the customer up to 37.7 million if it failed to comply with these confidentiality restrictions. Few people knew of the existence and location of the firm due to due diligence record, which were maintained in hard copy and not on Barclays digital system. This impacted how the customer relationship could be monitored on an ongoing basis and meant that Barclays could not respond promptly to the FCA request for information. Barclays case exemplifies the fact that the business interest should never take precedence over the compliance with law and regulations. The close relationship established in the private banking often require a high degree of confidentiality. However, the compliance check should not be reduced or minimized. A strong AML CFT compliance program are successful only if organizations follow the policies and procedures that support them. Failure to follow the regulation can lead to the fine even if no actual financial crime event occurred. The key takeaway from this case are business interests should not take precedence over the compliance with the law and regulations. The close relationship established in the private banking often require a high degree of confidentiality, but this should not reduce or minimize the required compliance check. Strong AML safety compliance program need organization to follow the policies and procedures that support them. Failure to follow a robust compliance plan can lead to the fine even if no actual financial crime event occurred. Let's discuss use of private investment companies PICs in private banking. In offshore and international financial center, private banking customers are often non-resident. That is, they conduct their banking in a country other than one in which they reside. Their asset might move overseas, where they are held in the name of corporate vehicles such as private investment companies (PICs) established in secrecy haven. PICs corporation established by individual bank customer and other in offshore jurisdiction to hold asset. They are shell companies formed to maintain client confidentiality and serve various tax and trust related purposes. PIC have been an element of many high profile laundering cases because they are effective laundering vehicles. The secrecy law of offshore haven where PICs are often established can conceal the true identity of customers' beneficial owners. As an additional layer of secrecy, some PICs are established by the company formation agent with the nominee director who hold titles to the company for the benefit of the individuals. These beneficial owners could remain undisclosed and sometimes are subject to attorney-client privilege and other similar legal safeguards. Many private banks establish PICs for their clients, often through an affiliate trust company in offshore secrecy haven. Criminal can establish complex cells, company network in which a company registered in one offshore jurisdiction might be linked to the company and account in other jurisdictions. The key takeaway from PICs, private investment companies, nominee corporate entities registered in high-risk offshore jurisdiction are an attractive vehicle for evading tax obligations. Care should be taken when dealing with assets associated with national non-national to reduce the risk of them being moved or placed to deliberately avoid tax. Facilitating tax evasion is a serious offense that can lead to a large fine and negatively impact a regulated firm's ability to do business with a certain customer and jurisdictions. Let's understand politically exposed person PEP. A politically exposed person PEP is an individual that holds a prominent public position or function. Due to their role, they may be more susceptible to bribery, corruption, or other money laundering offenses. Such as result of this, they are of high risk to the financial institution and designated non-financial business and professional DNFPBPS. According to FATF, there are three types of politically exposed person PEP, which are foreign PEPs, domestic PEPs, international organization PEPs. Let's understand this one by one. So the foreign PEPs, individual who or have in the past been entrusted with a prominent public function by a foreign country. For example, head of state or of government, senior politicians, senior government, judicial or military officials, senior executive of state-owned corporation, and important political party officials. Domestic PEPs, individuals who are or have in the past been entrusted domestically with prominent public functions. For example, head of state or of government, senior politicians, senior government, judicial, military officials, senior executive, state-owned corporations, and important politically officials. Third, international organization PEPs. Individuals who are or have in the past been entrusted with a prominent function. For example, managing director, secretary general, executive director, chairperson, and president by an international organization such as United Nations, six principal organs, but multiple specialized agencies, the IMF, the World Bank, the North Atlantic Treaty Organization, and the Organization of American States, OAS, among many other relative and close associate of PEP, are also considered to be a PEPs. The definition of PEP is not intended to cover middle ranking and more junior individual in the above categories. Let's understand structuring. Designing a transaction to evade triggering or reporting or record keeping requirement is called structuring. Structuring is one of the most common money laundering method. It is a crime in many countries and must be reported by filing a suspicious activity report. The individual engaged in structuring may be runners hired by launderers, that is individual who is travel from bank to bank depositing cash and purchasing monetary instrument in amount under reporting thresholds. Structuring can be made or can be done in many settings and industry including banking, money services business, casinos. Smurfing is a common structuring technique that involves a multiple individual making multiple cash deposit or buying multiple monetary instrument or bank draft in amount under the reporting threshold to evade detection. Let's understand with this with some example. First, a customer breaks a large transaction into two or more smaller transactions. Henry want to conduct a transaction involving $18,000 in cash. However, knowing that depositing it all at once would exceed his country cash reporting threshold for $10,000 and trigger the filing of currency transaction report. He goes to the three banks and deposits $6,000 in each account. Right. The second, a large transaction is broken into two or more smaller transactions that are conducted by two or more people. Like Jennifer wants to send $5,000 money transfer, knowing that in her country there is a threshold of $3,000 for the recording of fund transfer. She sends 2,500 money transfer and asks her friend to send another 2,500 money transfer. Third, an individual sent his fortune to another country. Mr. Lee, a wealthy Chinese businessman, sent his gained wealth of 1 million in sum of 40,000 US dollar via friend and business contact to the British Bank in London. The reason he does not deposit it into his own bank account in London is that the Chinese government has currency control in place for a transaction over 50,000 US dollar abroad. Let's understand this with a case example. In 2018, Commonwealth Bank agreed to pay 700 million AUD settlement plus legal cost. At the time, this was the highest penalty in Australian corporate history for the breaches of AML CFT laws. The Australian Transaction Report and Analysis Centre (AUSTRAC) accused the bank of the serious systemic failure to report suspicious deposits, transfers, and accounts. Those failures caused millions of dollars to be laundered on the behalf of drug importers through a method known as structuring. Structuring is the legal act of the splitting cash deposits or withdrawal into a smaller amount or purchasing monetary instrument to stay under a currency reporting threshold. Money launderers use structuring to avoid triggering of filing by a financial institution. In Australia, banks are required to file threshold transaction report TTRs to the AUSTRAC for transaction of 10,000 AUDs or more than within the 10 business day. CBA failed to report over 53,000 transactions that were run through an intelligent deposit machine IDM from 2012 to 15. IDM are a form of ATM that accept cash and check deposits. These deposits are automatically counted and credited in the CBA's account and made available in the immediate transfers, domestically and internationally. Austrac alleged that the CBA did not limit the number of transactions a customer could make per day. Its IDM allowed up to the 200 bills per transaction. A criminal who inserted a 100 bill AUD could deposit up to 20,000 AUD in one transaction, which is well above the mandatory reporting limits. IDM is also allow anonymous cash deposits. A card from any financial institution could deposit funds into a CBA's account. That is mean the criminal could potentially deposit millions of dollars through a machine in one day anonymously. Because the money appears instantly, a user could immediately transfer the money and to the another account, including the offshore accounts. In May and June 2016, more than 1 billion AUD in cash moved through CBA's IDM. Many of the transactions were deposited in the accounts that fell below the threshold transactions limit. Prior using IDM, CBA did not carry out AML CFT risk assessment. Despite alert raised in its internal transaction monitoring system, CBA did not conduct a subsequent risk assessment. In addition, CBA breached its obligation to perform check on 80 suspicious customers. Even when the structuring was suspected on the CBA's account, the institution failed to monitor these customers and conduct EDD as required when a suspicion is formed. The key takeaway from this case are structuring can involve many channels such as IDMs. Adequate control must be in place to ensure proper monitoring and reporting. New technologies need to be critically assessed for the AML CFT risk. And organizations need to limit the number of customers, daily transaction, and the number of bills per transactions. Let's understand microstructure. Microstructuring is another method of placing large amount of illicit cash into the financial system. It is essentially the same concept as structuring, although it is done at a much smaller level. Instead of taking $80,000 and breaking it into two deposits to evade a reporting requirement, the microstructurer breaks into 20 deposits, approximately 900 each, and making the suspicious activity extremely difficult to detect. In the case of Colombian drug cartel, the cash proceeds of US drug sale were deposited into the account in New York with link to the ATM card, which were provided to associate in Colombia. Deposits were made on the regular schedule, with the Colombian associate withdrawing the fund as they were deposited and giving them to the drug lords. In one case in New York, an individual was trailed by law enforcement authorities as he went from bank to bank Manhattan. When they stopped him, he had 1.65 US dollar in cash. 1.65 million US dollars. The red flag include the microstructuring are the use of counter deposit slips instead of pre-printed deposit slips, frequent activity in account immediately following the opening of the account with only preliminary and incomplete documentations. Frequent visit to make cash deposit of nominal account that are inconsistent with the typical business or personal banking activity. Cash deposit followed by ATM withdrawals, particularly in the high risk countries. A cash deposit made into a business account by the third party and no apparent connection to the companies. So this is all we have discussed in today's video. Thank you for watching. If you like the content, please hit the like button and subscribe the channel and ring the notification bell so you don't miss any upcoming videos into this channel. Thank you.